welcome to Indianomics. I have with me someone whom the entire investment community, the entire business community, anyone who is interested in the financial sector wants to hear. Chanda Kochhar, Managing Director and CEO of ICICI Bank. Chanda, thank you very much for joining us.
Pleasure, Latha.
You all did give a very detailed presentation after your results. But there are always afterthoughts and after questions. So let me start with what everyone wants to hear about the asset quality. You told us that your worry list or your stress sector exposure list is 44,000 crore. What's your best guess as to how much might slip into default?
So first, since you spoke about the results, let me just, for good order's sake, reiterate some of the parts of the results.
Sure.
Is that, as you look at the quarter's results and the yearly results, you would have seen that we have actually, on a prudent basis, made an additional reserve of 3,600 crores. That's towards the future. So, in fact, if you look at our profits, with taking into account the provisions that were required for the year for the NPA and restructured assets, we could have, or we had a profit of almost similar that was the previous quarter's profit. The second is, even after taking into account that additional reserve, the bank still has, on a consolidated basis, a profit of more than 10,000 crores in the year. So, a consolidated profit of more than 10,000 crores, created a reserve of 3,600 crores, and of course having the substantial capital adequacy and the value in its subsidiaries. From there on, now coming to, the list that you spoke about. Well, what we have disclosed is really a further drill down disclosure on our assets. What we've said is that there are 5 sectors today that have been clearly impacted by the global commodity prices and by other economic conditions. And all the portfolio that is below investment grade internally classified. So we have just given more details about those. And that is really the list of the portfolio. We've added the fund and non-fund based exposure. It's across our domestic book as well as the international branches. And it covers all the below investment grade. There's also a fact that we have an action plan around each of those companies. We are working on resolutions with the promoters for them to either sell their core assets or their non-core assets to reduce their leverage, because of which some of these exposures for us will go down, some of them would move to better rated entities and so on. I think beyond this, it's not possible really to say what out of this will flow into NPAs and what out of this will not flow into NPAs.
No, not what. It's only a ballpark. Axis said 60% would be the outer limit. They don't believe it is going to be 60. So if you can guide on those lines.
So actually, as I said, resolutions are on for many of these exposures. Some of these are actually large exposures for which you would have read, reports about deals being done, sales being, finalized and so on and so forth. So we are actually very hopeful that some of those resolutions would work out. But at the same time, as I said, in today's day and age, even after, you find a buyer, first of all, when the promoter agrees to sell, with the low commodity prices, you have less buyers today than sellers. Secondly, even after the buyer is found, you need to go through the court approvals, the competition commission approvals and so on. So that could take, different points of time. And then during that period, the regulator has the approach of early and conservative recognition.
Yes.
So that's why I'm saying it's difficult to say what part of it, and it's better actually not to say what part of it. But we do expect resolutions around many of these cases to happen actually.
Okay. Now these are only your 5 stress sector sub-investment investments. Can you tell me, what is your exposure to the non-stressed sectors, the other non-5 recognized sectors, and your exposure to sub-investment companies in those sectors, in the balanced sectors?
Yeah, so since we have so far, never given all that breakup, we thought that it was prudent to start with these 5 sectors, and to this we have added also the promoter entities that are linked to these 5 sectors.
Okay.
So we believe that bulk of the NPA formation will happen out of this. That does not mean that there would be not other sub-investment companies that would not become NPAs. There would be some NPA formation from the other sectors as well. But since these, it is in these sectors that it is more concentrated, we've disclosed these sectors.
Okay. Not even a ballpark figure, a percentage on what is the exposure in the non-5 identified sectors that you can share?
Since we've not shared it with the investors, analysts, I should not be doing part disclosures.
Okay.
So.
What is this goes out publicly to all your investors and viewers. So, I mean, it's not selective at all. They will know it as soon as you tell me. What is your investment book and what is the advances book? I think your total loans are about 4.5 lakh crore. In that, your corporate would be half of that? 2.3 lakh crore?
Yes, almost half, a little less than half.
Okay. So how much would be investment and how much would be advances?
So most of it is advances, and investment book actually for us is very small. It's just about in the region of about 6,000 crores.
Okay.
So it does not move the needle here or there, and they are mostly high-rated investments because the philosophy that we've been following is that we don't take credit risk in the investment book. We generally, it's all there in the loan portfolio in any case.
Okay. You spoke about resolution of many of the assets. Now, is SDR succeeding?
Yes, SDR is moving. In fact, we've had one good success in the SDR, one of the construction companies where we actually exercised SDR, and after, it's not just about exercising SDR, but after the exercise of SDR, we've been able to break the company into 3 parts, 3 different businesses, found a buyer already for one of the business and, transferred the loans, part of the loans to that business. Finding the buyer for the next part of the business is in progress. That should happen soon. Then the company will be left with just a residual loan and residual portfolio. So I think that's one of the first successes, if you would say, in the industry that we've been able to achieve from the SDR. So I think SDR is a very important and a very useful tool. It's just that, as I said, somehow, the availability of SDR has also coincided with this very low commodity cycles and investment cycle. So it just takes time to find buyers. And, if you don't have a ready buyer or a prospective buyer, then it's not worth doing an SDR and just transferring the shareholding.
No, that's exactly what bankers were complaining. They are saddled with, they have become the owners of the company if they exercise the conversion from loan to equity. And then if the promoter has not paid Provident Fund or, reneged on sales tax, it falls on them. That's why I was asking you if it is succeeding at all. But you're saying that it has succeeded in one case.
It succeeded in one case, and therefore, the way to measure the success would be that, we should not just jump into exercising SDR without having a plan of action. So where we have a plan of action, where we think we have prospective buyers, we should do SDR and not absolutely. Otherwise, if we jump into it, we'd be saddled with those responsibilities.
Would you say that maybe at the end of FY17, which is again one banker's guess, there will be more asset sales? Because like you, others are also providing. And because by end of FY17, you all may have provided as an industry 30-40% of the stressed loan, you will be willing to take write-downs. So should we expect more resolutions by the end of this year?
I will not put it as 1 year or the other, but I would say that actually there would be improvement in asset sales as the economy improves and as the commodity cycles improve. So in any case, we have to hope for, that improvement to take place. And that is what will really then bring more buyers on the table.
There were some instances, like for instance JP Group. They were willing to give you land in lieu of interest. Has that been cleared by the regulator?
I should not talk about a company-specific thing, and at the same time, I should not talk about specific stands taken by the regulator. So it's unfair. But on a general basis,
I believe you all were going to the regulator.
So, yeah, but then, as I said, the discussion between a regulator and a regulated entity should be kept within the discussions on the discussion table. So, but I would say that, when we look at physical assets, we look at the value underlying the physical assets. We look at, what is the possibility of us having a long-term action plan around that physical assets. And if It is a one-time, once or twice kind of thing of, collecting or rather reducing the debt, collecting the debt in some way or the other, then I think that's the plan to take. But you should finally have an ultimate action plan for the company which is outside of physical assets.
What do you do with, say, for instance, a loan like SR? It's a big loan and it's difficult to find a buyer for that. Will you all be able to take a write down because you have provided for it? So, therefore, do we see such a big loan getting sold off or resolved in some fashion, a strategic investor finding an investor? Is this loan resolvable in any fashion?
So again, let me actually not comment company specific or group specific, but I would only say that even for large exposures, there are interested buyers and there are ways of working along with the existing management to bring about change in management to resolve these cases. So in fact, some of the larger cases are actually, the banks are working towards resolving them.
No, okay, I'll once again tell you why I'm pressing on specific big cases. Because, the number is not, the number is worrisome. If you take this 26,000 odd GNPA that you have already declared and add to it this 8,000 crores and add to it this 4,525 case and then even 50% of your 44,000 crores, we are actually talking about a 60,000 crore. That is over 10%. That's why I'm asking you if any of this will be resolved.
First of all, Latha, let me tell you that, as I said, resolutions are underway, and I'm quite hopeful that some of these resolutions will happen. Just as you say that some of the exposures are lumpy, actually when resolutions also happen, they would be lumpy resolutions. So that's one thing that you should keep in mind. The second is, while you are adding all this up, you should not assume that all of it is a problem. The third is that when you look at the loans and advances, actually you should look at the exposure. You're talking of a bank where the exposures fund plus non-fund based overall, it's a 9 lakh crore book. So we are talking of this vis-a-vis 9 lakh crores. Yes. We are talking of again a bank that has a net worth of 94,000 crores. We're talking of a bank that over and above the net worth has the ability, if at all, to raise other forms of capital like tier 2 and so on, because our capital adequacy already is 16.6, but within that tier 1 is more than 13. So you have enough tier 1 capital and enough ability to increase any other forms. You're talking of a bank where we have, even just on the basis of the 2 deals done in insurance companies, the value of our 2 insurance companies is more than 33,000 crores. Then you're talking of a bank, where you have other subsidiaries which have other values. So, I think you're talking of a whole lot of strength on the other side in terms of balance sheet. Now let me come to the running business strength. We're talking of the fact that we have technology and digital leadership across the businesses that we run. A very strong retail franchise where even our savings deposits were growing at more than 17%, a CASA ratio of more than 45%, retail assets growing more than 23-24%, very strong iMobile application and various other forms of digital businesses. So I think you're talking of a very large franchise.
Will there be any need to raise capital, therefore, in a hurry?
So as I said, we don't need to raise equity capital for the moment at all. As I said,
so in the next 2 years?
No, in the 2 years also we don't need to raise equity capital because we have so much of ability to release capital from these subsidiaries, partly from the overseas banking subsidiaries, from the insurance subsidiaries. We have ability to raise tier 2 capital if we want, and anyway with all this we have a tier 1 even today of 13%.
Well, Chanda, I think I've asked you a lot of questions on your results. A few more questions on the macro economy, but after a very short break, we are back.